The housing trap: how monetary policy deepens inequality and stagnation. The policy paradox of the two-way system. Action A: raise interest rates, intended to curb inflation. However, it increases returns on capital, attracting more investment. Since housing is a primary investment vehicle, this can further inflate house prices, making ownership less affordable and exacerbating homelessness. Action B: lower interest rates, makes mortgages cheaper, providing a breather and stimulating the economy through construction and spending. However, this also fuels house price inflation, kicking the affordability can down the road and potentially creating a larger bubble. The result: this creates a vicious cycle, or stagnation, where neither monetary policy tool solves the underlying disease, they just treat opposing symptoms. The wealth gap widens as asset owners get richer and non-owners get poorer. The flawed premise: the system mistakes higher house prices for economic growth, when in reality it is often just the accumulation of debt and inequality. The proposed solution: shift the focus from housing as an investment asset to housing as shelter. The real solution is to increase fundamental organic demand by raising wages, ensuring that growth is broad-based and linked to actual productivity and purchasing power, not financial speculation. Our economic system is paralyzed by a fundamental contradiction. We mistake soaring house prices for national economic health. This conflation creates a perverse cycle in which conventional monetary tools, designed to ensure stability, instead deepen the crisis. The mechanism is self-reinforcing. In a supply-constrained housing market, any demand-side stimulus pushes prices beyond ordinary affordability. When central banks raise interest rates to combat inflation, they unintentionally amplify this problem. Higher rates make secure, high-yielding investments more attractive, and as property remains a primary asset class, capital continues to flow into housing, further inflating its value. The result is a cruel irony. A policy intended to stabilize the economy makes homeownership increasingly unattainable, exacerbating inequality and homelessness. Conversely, lowering interest rates offers temporary relief by reducing debt costs and stimulating spending. Yet this stimulus comes at a severe long-term cost. It injects more credit into the existing housing shortage, inflating the speculative bubble and cementing our unhealthy dependency on this single sector for illusory growth. We are left with no viable monetary options, making economic stagnation inevitable. The only escape is to break this cycle. We must cultivate genuine organic demand by driving up wages, ensuring that Kiwis can afford housing through productivity, not speculation. An economy supported by moderate inflation and rising wages generates real, sustainable demand for goods, services, and housing. This is the foundation of authentic growth, where prosperity is measured by increasing affordability and broad-based well-being. The current path is an abstract monetary game that imposes austerity on the majority. While the wealthy benefit from inflated asset markets, everyone else struggles under the weight of stagnant incomes and rising costs. This is not a recipe for shared prosperity, but a guarantee of sustained inequality and profound economic fragility.